Welcome to Kings and Queens accounting class. Another time, we have the privilege and opportunity to share with you as it relates to matters of accounting. I hope that you have been enjoying the previous classes that we have shared with you and that it has been excellent in your learning process. Today, we are going to be looking at the topic cash book preparation. The cash book is one of those books in accounting that is critical in the operation of the business. Very, very important in the operation of the business. A matter of fact, the cash book is more like the lifeline to the organization or to the business. It's like the lifeline because what happens is cash flow is important to the progress of the business, buying and selling, the payment of expenses, the purchasing of supplies, etc. So the cash book is an essential book to every business. And so we're going to be looking at it at this time. To guide our deliberation, we'll be looking at what is the cash book, explain important concepts, and we're also going to seek to explain the rules in preparing the cash book. So let us get right into it. First of all, what is the cash book? So the cash book is a ledger. Yes, the cash book is a ledger that contains the cash account and the bank account. So the cash book is really the book that our ledger that contains the cash account and the bank account. So we record an impression of our bank account. So we keep data or information in relation to what our account at the bank should look like. And of course, the bank will also have an account for us. All right. Later on, we'll be discussing the whole matter of our bank account reconciling with the bank account at the bank. All right. But today, we're saying that the cash book contains the cash account and the bank account in one statement. So we can move now to the next objective quickly. Explain the importance of some concepts. Now, in dealing with the cash book, there are some concepts that we ought to bear in mind. And one of them has to do with the folio. Now, A, folio. The folio column in the cash book is critical. You may ask, what we mean by that? It's a column that is in the cash book that is used as a cross-reference. Yes, is used as a cross-reference. It is done to be able to track. So the folio column is used for cross-referencing. Used for cross-referencing. And why? Because what we want to do is to be able to track the items. Well, track the items in their respective ledgers. So we want to be able to track the items. Do they really pay us? For example, if we sold some goods to a customer and we would have had that on credit. If we sold some goods on credit to a customer, we would have had that information recorded in the sales ledger. Yes, that particular customer is owing us. But so when that customer pays us, yes, we want to be able to show that no, we no longer have that customer as a debtor because the individual would have paid us. So when we record use the folio in the cash book, we can cross-reference to make sure who had paid us and to what extent they have paid off all that they owe us. Yes? So that is why the folio column in the cash book is very critical, or most important rather, in order to cross-reference to determine what is happening in the other ledgers. All right? The other concept that we would like to talk about in cash book is what is called discounts. Yes, discounts. The concept of discount is really about a reduction in the original price, right? And so when we give a discount, we're doing a reduction in the original price. So we are reducing the original price of the goods for one couple of reasons. One may be because the customer or we are paying off for the supplier the goods promptly or quickly, so they give us a discount. And or in the case of this of the quantity for which we are buying, yes, if we're buying a large quantity, then we may also obtain discounts. All right, so we know that discount is really the reduction in the original price. Now there are what we refer to as trade discount and cash discount. Now, trade discount is offered based on the quantity. So it's when we are buying in large quantity, we get trade discount. However, cash discount is about the promptness. So it's about prompt payment. It is to encourage the customer to pay you quickly. So you're buying the goods, or your customer's buying, and you say, well, if you pay me by X time, then we'll give you a discount, right? That is really a means of encouraging the customer to come in quickly and pay for the goods and reap the benefit of the discount. So once again, discount has to do with a reduction in the original price. And we're saying there are two of them. You have what is called trade discount and cash discount. Now, trade discount is given based on the quantity that is being bought or sold. And cash discount is given based on the promptness of your payment, right? Whether you are paying quickly. Now, the discount that we will be paying attention to in the cash book, most of all, is cash discount. Cash discount. And cash discount comes in two forms as well. So let's go over here, cash discount. It's in two forms. One is referred to as discount allowed, and two, discount received. All right, so there are two sets of cash discount. One has to do with discount allowed and the other is discount received. All right, I want to move so that it is clear here for you to see what we're doing. So let me make. All right, now, so what is discount allowed? That's maybe a reasonable question to ask. What is discount allowed? All right, we understand cash discount is that we are paying for the goods early, so they are reducing the amount that we pay. So what is discount allowed then? Discount allowed is really discount given to our customers. Discount given to our customers for prompt payment. Right? So we are the ones, our business, we are the ones that are granting the customers a reprieve or a reduction in the amount that they should pay. So if we had sold the goods for $1,000 and we say, all right, if you come within the next 10 days, sold the goods for $1,000, yes, and we say if the customer comes in and pay off for the goods within 10 days, they'll get a 10% discount. So that means we are allowing the customer, yes, a reduction. So the 10% discount will mean a reduction of $100. So they will get a reprieve or a reduction of $100, and what they would pay would be $900. So that is discount allowed. Let's go to the next one, discount received. We'll take it right here. Discount received, and in this instance, we are now the supplier. Let me do this because I don't want you for this to impede. So let's go. So it's where the supplier grants the business a reduction. Yes? So we buy goods from the customer, the supplier. We are buying the goods from the supplier, and the supplier is saying, because we are going to be paying them, yes, early, they will receive discount. Right off the bat, let me just tell you that discount allowed is referred to as an expense, and discount received is a revenue. Okay? Very important point. So in this case, discount allowed is an expense. And why is it an expense? Important question. Why is discount allowed an expense? Well, let's go back to this little example I had here. We would normally be receiving $1,000 from the customer. Yes, we're normally receiving $1,000 from the customer. But we have allowed them a reprieve or a reduction of 10%. We reduce it by $100. So it's an expense to us. Instead of getting an income of $1,000, we're getting an income of what? $900. So this is a cost to us. This $100 that we're giving up is a cost to us. So that's why it's referred to as an expense. On the other hand, in the event here, we would have probably, if it was where we are paying the supplier, right? The supplier is giving up, and to us it is an income because we are retaining some of the money. So if this instance was in relation to us buying or paying our suppliers, yes, and they are reducing the money, then it becomes an income because instead of paying them the $1,000, we are paying them $900. So we are withholding, or we are holding back, or getting $100. So it's an additional income to us, right? That's why discount received is referred to as a revenue, and discount allowed is an expense. So discount allowed is where the business is giving to the customers or the client a reduction because they are paying quickly, as against discount received, where because we as the business are paying the supplier early, the supplier is giving us a reduction. All right, there's another concept that I'd like us to look at, right? And that has to do with contra entry that comes in cashbook. Refer to it as contra entry. And you may say, but what is this? Contra entry. Really, this concept really comes out of the idea of the movement of money between the cash and the bank. The movement of money. So when we talk about contra entry, we're referring to where money, referring to the movement. Let's put it like that. Movement of money between cash account and bank account. That is what is meant by contra entry. We are moving money. So let's say, for argument's sake, most businesses at the end of the business day, they would package their sales and then go off to the bank to deposit. So that is a contra entry where I'm moving money from the business and put it into the bank. So it is moving from cash going to the bank. And the inverse occurs from time to time. We may have a cash flow problem at our business place, or what is referred to as our float. Yes? And so we would go to the bank, withdraw some cash to put in the business to keep it going, right? To have it liquid to be able to pay small expenses, etc. So contra entry is really referred to where there's movement of money between, yes, cash account and the bank account. And it can go either way, either from the bank to the cash or from the cash to the bank. There's another concept. I think we would have spoken about it earlier in our course, but I'm still going to be speaking to it. Why? Because it is relevant to the topic, and that has to do with bank overdraft. Bank overdraft. Now, bank overdraft is where the business is allowed to pay out more money, yes, than they have in their account. So it's an overdraft. The word this here is important. Overdraft. You have the bank is lending you money as a result of the fact that you may be a good customer. You have been working with the bank for a number of years and you have a certain reputation with the bank. Yes, so the bank will not dishonor the checks that you have written, but rather they would pay out the check to the persons you are paying, the payee, or those persons, your suppliers or your creditors that you have owed. They would pay those individuals, yes, and then give you a call or let you know that, listen, your account is in arrears, or your account is in a negative. So you would now have to go in and pay place money into the account, and of course there is an interest cost for allowing you, all right, that kind of facility. So bank overdraft takes place, and I say particularly when the business has a good working relationship with the bank over a period of time. So the bank will not embarrass the business by rejecting the check, or causing, or what we call dishonor the check, but rather they would pay the customers or pay the creditors, and then will have dialogue with you to determine how you are going to be treating with that balance. So yes, bank overdraft is where the bank really is, it's a form of a loan. They are lending you money because of the situation by paying the person. Yes? Okay, so, and we had said some time ago that bank overdraft is a liability. More or less, we said current liability, right? Bank overdraft is current liability. So since we're going to be talking about the cash book, which contains the cash account and the bank account, we would really like to share that information with you as it relates to the bank account. And there can be an overdraft. That means you have expended or drawn more value that's it, that's okay, more value than is in your account. All right, good, nice. All right, so we would have completed objective 1 and 2 by explaining those concepts. We are now going to be looking at the third one. How do we treat with the cash account, right? The cash book, the rules relating to the cash book. There's something I want you to know, is that in the cash book, and I'm going to do a little sketch here. In the cash book, there are a number of columns, yes? And this is referred to as the vertical format, or horizontal, beg your pardon, format. So in the cash book, there are 2 sides, and the double line indicating the sides difference. So this is the cash book, and the double line indicates the difference. This column, this would be the date. I'm using just the first letter. Date, this will be the details. This is the folio. This is discount. This is for cash. This is for bank. Date, details, folio, discount, that's D, C for cash, and B for bank. All right. When we get on the other side of this lesson, we will be doing the practical. But just for the explanation in the rules in terms of the cash book. Now, the double line indicates that the difference between the sides. So everything over here would be referred to as the debit side, and everything over here would be referred to as the credit side. Now, in recording, the rule in recording in the cash book only record transactions relating to cash and check transactions. Cash and check transactions. We also know in our 21st century that we are having as well bank cards. So the bank cards in terms of debit cards and credit cards. Yes? All of those would be relating to the bank. The debit card, the credit card would also be relating to the bank as well as the cash. Those are banking instruments. Yes? And cash. But let's go on. So we're saying that whenever the business is receiving money, because the cash book looks at the flow of money, the flow of money. Money flowing in and flowing out. Money going out and coming in. Let's go again. Money going out and come in. So when we are receiving money, yes, I've always indicated to my students, you always, can, a little thing here is receive. So you remember that everything over here is when we are receiving the money that we record on the debit side. When we are paying out the money now. When we're paying out, is on the credit side. So once we read the transactions, once we are reading the transaction, we're reading to determine, yes, whether the money is coming in or the money is going out. When the money is coming in, we record the information on the debit side. When the money is going out, we record the information on the credit side. Whether it be cash or check or debit card or credit card, whatever it is, whatever item, monetary instrument we're relating to here. Once we're treating with the cash book, then we are going to be recording when we are receiving money on the debit side and when we are paying out money on the credit side. Very important concepts that one needs to learn or understand in treating with the cash book. Ladies and gentlemen, it was my pleasure, yes, to share with you. We'll be having the second part of this cash book preparation, where we look at the practical side of it and with exercises. But for now, we thank you for sharing, and I hope that the concepts were made simple and clear. Have a good day. This is Kings and Queens Accounting Class. Please be kind to us and like and subscribe as you click below this video. Thank you.